All right, so this picks up in kind of the middle of chapter 5 because this is chapter 5, part 2. All right, so let me make sure I label that clearly. Okay, so part 1 is already posted. This is part 2. Okay, so let's start off with different types of income. And why do we care about different types of income? Well, as we've already seen, different types of income are dealt with differently from a tax rate perspective, but also sometimes from a recognition perspective. Okay, so first of all, we have earned income. Okay, so this is generated by the efforts of the taxpayer. Okay, now income from property is considered unearned income. All right, and we care about this for a variety of reasons. First of all, you can see that gains or losses from the sale of property, okay, sometimes these have preferential rates, right? So can have lower tax rates, okay? And then sometimes you have to look at the type of transaction, okay? So it's important to recognize whether we're talking about earned income or unearned income. And specifically, we're going to have credits related to earned income as we get a little bit later on in the semester. All right, so one of the things that we have to talk about in this chapter are annuities. And I'm sure you have talked about annuities in your finance classes, all right? And you've talked about them from a present value perspective. But the good thing from a tax perspective is what we're concerned about is which part of the annuity from a payment perspective is going to be taxable, okay? So let's focus in on this second bullet right here. A portion of each annuity payment, all right, is a non-taxable return of capital, but then there's a part that is gross income, okay? So this remainder, okay, that is taxable, all right? So there is an annuity exclusion ratio, all right? And that is going to help us determine the return of capital part, which as we see here, the return of capital part is non-taxable, all right? And then the remainder is taxable, all right? So right here, this last bullet is your formula. And we're going to go to the next slide and do an example, and we'll see how that formula works. All right, so here we go. All right, so in this example, what have we got going on? Well, we've got a fixed term annuity. So what that means is we're told how long this annuity is going to last. Okay? All right, and so what do we have? Well, in January, Graham purchases an annuity for $99,000. The annuity pays $10,000 a year for 15 years. How much of each $10,000 payment should she include in her gross income? All right, well, first, let's look at our formula, okay? All right, so I'm going to rewrite the formula. It's on the previous slide, but I'm going to rewrite it here. Okay, so a couple of things to notice in particular about this formula. First of all, this is an exclusion ratio, all right? And so you may be going, okay, that's fine. Why do we care that this is an exclusion ratio? Why is that of particular interest? Well, That's of particular interest because since it's an exclusion ratio, this is going to find the portion of the payment that is excluded from income. So this ratio finds the portion of the payment that is excluded from gross income. All right. So what you're finding by this formula is the non-taxable part. All right. So let's talk about our problem in particular, this particular example, and we'll run the numbers. All right. So we're going to find this ratio. So we're going to say excluded portion is equal to the original investment. Okay, so what was the original investment? Well, the original investment was $99,000. That's what we purchased this thing for. All right. Now, what is the expected value of the annuity? Well, the expected value of the annuity is how much that thing pays over the course of its life. Okay, so the expected value in this situation, it's going to pay $10,000 a year for 15 years. So that's its expected value. All right, that's what you learned to calculate in your finance class, or you figured out how much it could pay each year based on a rate of return. In tax class, we don't really care about that, right? What we care about is what do we end up putting on our tax return. All right, so our exclusion ratio in this case is $99,000 over $150,000. All right, so our excluded portion equals 0.66 or 66% of the annual payment. All right, so I'm going to slide up again. So then the excluded portion is 0.66 times 10,000 because that was how much our annual payment is. So that's $6,600, right? 66% of 10,000. All right. So what is included? And you know what? I should change colors here. So included in gross income equals our payment minus the excluded part equals $3,400. All right. So this $3,400 is taxable. It goes into our gross income. Okay? So that is how you deal with annuities. Okay? Now, how else do we get income? Well, sometimes we sell something. All right? In the tax world, we call this a disposition. Okay? We could just say a disposition actually means a sale. All right? Sometimes it means we donate it. All right? A disposition is we're getting rid of it. Okay? So what happens when we dispose of an asset, when we sell an asset? Well, we recognize either a gain or a loss, right? And we, again, are allowed to recover our investment in the property before we realize any taxable gain, okay? And that investment in the property is called our tax basis, okay? So here is the formula for calculating the gain or loss from the sale of an asset. And this is, you're going to look at this and go, well, yeah, this is how we calculated gain or loss for financial accounting. Yes, it is, okay? So sales proceeds, right? What you receive, okay? Minus your selling expenses, that's your amount realized, minus your basis, okay, which is your investment in the property, and that's going to give you your gain or loss, okay? So there's nothing magical there, right? It's just a matter of remembering that your return on investment is not taxable, okay? All right, so what do we have from other sources of income? Well, so income from flow-through activities. And we've already talked about these to a certain extent, right? And this is why we had to talk about Chapter 15 prior to Chapter 3 and 4 and 5, right? So that you understood what a flow-through entity was. So we can invest in various types of business entities. We've talked about partnerships, LLCs, S corporations, sole proprietorships, okay? All right? And if the entity is a flow-through entity, all right, then the income and deductions flow through to the owners, all right? That's the whole reason for a flow-through entity. That's where the name comes from, okay? So what we're going to cover now, I'm going to call this like the cats and dogs of income, all right? There are all kinds of different sources of income, and so you're going to need to know what to include or not to include on a tax return, all right? So here we go. We've talked about flow-through income, all right? Alimony, all right? Let's talk about alimony, okay? So there is a specific definition of alimony, all right? For our purposes for this class, you are not going to have to define alimony. You are going to have to recognize the difference between alimony and child support, okay? Child support is not taxable. Child support is not a 4AGI deduction, okay? Alimony is fundamentally different than child support, okay? So alimony used to be, all right, gross income to the person receiving the alimony. It was taxable. And then the person paying the alimony had a 4AGI deduction, all right? That has changed. So I'm going to expand here, and here are some details about alimony, okay? If divorce decree was prior to January 1, 2019, all right, alimony is gross income to the person receiving it and a 4 AGI deduction for the person paying it. However, if the divorce decree was after December 31st, 2018, alimony is not taxable or deductible. It's nothing, all right? So Okay, so this change in how alimony is treated is one of many changes that came about as a result of the Tax Cuts and Jobs Act. Okay, so so it used to be that alimony was always recognized as taxable income if you were receiving it, and then if you were paying it, it was a 4 AGI deduction. Now we have this split timing-wise because of the Tax Cuts and Jobs Act. Okay? All right. Let's talk about prizes and awards. Okay? Prizes and awards typically are included in income. Okay? I do a lot of trail races and bicycle races and triathlons. And from time to time, I win small amounts of money or different prize type things, shoes, etc. All of those types of things that I receive are taxable. That's included in my gross income. Okay. If I receive a best paper award that comes with it some type of a monetary payment, that also gets included in my gross income. Okay, so prizes and awards are included in your gross income. All right, there are a couple of notable exclusions. All right, and here you go. All right, here is one. If the prize and award was made for scientific, literary, or charitable achievement, and it's transferred directly to a qualified charity. Okay, so think Nobel Prize as an example, but must go directly to charity. All right, so that's one example. Another example is if you get an employee award for the length of service or for a safety achievement. Okay. And there is a $400 limit per employee. All right, so if you receive an Employee of the Year award and it's for $300, that can be excluded from your income. Okay. And then there is another new exclusion, and this is Olympic, the value of Olympic medals. Okay, but there are AGI limits for that. Okay. All right, so let's talk about other types of income. Okay. Social Security benefits. All right, I'm going to put a big circle around this because I will do an example problem with Social Security benefits because there's a whole formula to determine whether your Social Security benefits are taxable or not. All right, and so stand by on that. We'll talk about that later. Okay. Imputed income. All right. Imputed income can also be taxable. All right. And what is imputed income? Examples of imputed income can be employee discounts above a certain level. Okay. If you get a special low interest rate on a loan, all right, that can cause imputed income. All right. The other thing that can cause a taxable income situation is discharge of indebtedness. All right, so what is discharge of indebtedness? If a lender forgives your debt. Okay, so if your lender forgives your debt, then that amount of debt that you were forgiven is income to you. The only exception to that is if you are insolvent, all right, then that discharge of indebtedness, then we'll call it loan forgiveness, is not taxable. All right, so one of the things that is being discussed and is continually discussed is like forgiveness of student loans. Well, as it currently stands, if your student loan is forgiven and you're not insolvent, meaning your assets are still larger than your liabilities, then that would be, you would have taxable income as a result of that discharge of indebtedness. So say you have $10,000 of student loans and those are forgiven. Well, now you have $10,000 of taxable income because that debt was forgiven. Okay, so when they talk about forgiving student loans, one of the things they're also discussing in Congress is what to do about the income effects of that discharge of indebtedness. Okay, so something to pay attention to. All right, so what about things that are excluded from income? Okay, so, sometimes Congress allows specific types of income to be excluded or deferred, all right, in order to subsidize or encourage specific activities. Okay, so what are excluded? What types of things are excluded from income? Okay, so these are, we'll say this, do not result in taxable income. Okay, municipal interest. We've already talked about that one, right? The interest from a municipal bond. Okay, gain on the sale of a personal residence. Okay, and there are some specifics in the book about this. I'm going to slide over and write a couple of things. So for married filing jointly, you can exclude gain on sale of your principal residence up to $500,000. All right. And there are a couple of things, right? You have to have lived in it for a certain period of time. Okay. But you can exclude the gain. Okay. Fringe benefits. All right. This is kind of a really cool one because there are qualifying fringe benefits that your employer can offer, and these things are excluded from your income. Okay. There are education-related exclusions. So scholarships. All right. If your scholarship is for tuition, fees, books, supplies, all right, then that is excluded from income. If your scholarship requires you to teach, then it can be taxable. If your scholarship pays for room and board, that portion of your scholarship may be taxable, okay? So you have to be careful with scholarships, okay? And then there are exclusions that are designed to help limit double taxation, okay? And what is double taxation? Well, if that income has already been taxed once, then there are some exclusions to help eliminate that same income being taxed again. All right. Okay, so an example is gifts and inheritances. Okay, so I can give anyone, all right, so gifts of $15,000 or less do not create taxable event. All right, so let's pause a minute and talk about gifts. Okay, I find that lots of people misunderstand what the taxation around gifts. Okay, I could decide right now to give every single one of you in class $15,000. Okay, if I give every single one of you $15,000, you guys walk away $15,000 richer. You do not have taxable income as a result of that gift. Okay, $15,000 is the gift exclusion amount right now, which means if I give each of you $15,000, I do not have to pay a gift tax on that gift. Okay? Now, let's say instead that I decide to give each one of you $20,000. All right? So I give each one of you $20,000. You guys still do not have any taxable income as a result of that gift. You guys walk away $20,000 richer, no tax implications. Okay, so the whole point of this conversation is to let you know that if you receive a gift, that is not a taxable event to you. Okay, if you receive a prize or an award, that is a taxable event to you. If you receive a gift, that is not a taxable event to you. Who pays the gift tax? Well, the person giving the gift may have to pay a gift tax. All right? So it's important to realize that if someone receives a gift, the receiver is not paying tax on that gift. Okay? Let's also talk about inheritances and estate tax. Okay? Right now, the estate tax exclusion is a little over $11 million. So what that means is if I were to die, okay, and all of my assets would pass to my husband and my children, okay, if the value of all of my assets is less than $11 million, then my estate does not pay taxes, and my heirs, the beneficiaries of my estate, the receivers of my assets, do not pay taxes either. Okay, if my estate were to be valued at over $11 million, then my estate would pay tax on the amount of the value, of my assets over that $11 million exclusion amount. And we can talk more about that with specific examples, but I think it's important to kind of get it out there that it's a bit of semantics, but when there is estate tax, the beneficiaries are not paying that tax. The estate of the person that has deceased is paying the tax when there is tax on an estate. Okay? All right, finally, life insurance proceeds. Okay? If you have a life insurance policy, okay, the life insurance proceeds, all right, those life insurance proceeds are typically excluded from the income of the recipient. So again, if I die tomorrow and I have a life insurance policy and my husband and 3 children receive my life insurance proceeds, those would not be included in their taxable income. All right, more exclusion provisions, all right? So this foreign earned income, all right, we will talk about that in an example as well, okay? So that'll be a lengthier discussion than we want to do within this PowerPoint. All right, so sickness and injury related exclusions, all right? Workers' compensation, all right? Payments from a workers' compensation plan are excluded from gross income, okay? Also, payments associated with personal injury, all right? Awards that relate to a physical injury or sickness, or payments for medical costs of treating emotional distress are excluded from gross income, okay? Payments that are like punitive damages are fully taxable, okay? Healthcare reimbursement, not taxable, all right? And the key word there is reimbursement. They're just reimbursing you for something you've already paid, okay? Disability insurance, all right? We need to talk about this one in particular, okay? Sometimes this is called wage replacement insurance, okay? So this pays, what disability insurance is designed to do is pay for wages lost if the individual misses work due to injury or disability, okay? So this is like those Aflac commercials, right? It pays you when you can't work, right? Gives you cash when you can't work, okay? If the individual's employer purchased the disability insurance, okay? And those benefits are excluded from compensation, then the benefits are taxable, all right? What I want you to pay attention to with disability insurance is pay attention when you're looking at disability insurance to the difference between premiums and benefits, okay? Because there are a couple of questions that ask you, are the benefits taxable? Remember, benefits are what gets paid to you when you get hurt and you can't work, okay? The premiums are what you or your employer pay to the insurance company, okay? So if your employer purchases the disability insurance, okay, so if your employer pays the premiums and those are not included in your taxable income, then the benefits are taxable, all right? If, however, if you purchase the premiums yourself, then those benefits, if and when they pay out, are not taxable, all right? So it's very important to pay attention to the difference between benefits and premiums, all right? And then we have all kinds of deferral provisions, all right? And what do deferral provisions mean? It means that you're not going to get taxed on that realization of income right now, but down the road, there might be some tax implications. So we're talking about installment sales. We're talking about like-kind exchanges. We're talking about involuntary conversions, okay? Roth IRAs, all right? So you need to know that all of these items exist and kind of what they are very basically, but for the most part, the details of those are well beyond the scope of this course. All right, so that concludes this part of Chapter 5. So this is Chapter 5, Part 2. I will also be posting some practice problems, and we'll work some practice problems specifically around Social Security benefits, and we'll talk about foreign earned income as well. All right, that's it. Thanks a lot.